5/17/2013. Good afternoon, MMTs, and good afternoon to all traders. One of the things that I'm going to point out on the S&P 500 today is that back when we were over here in this month, this was back in 12/11. This is a monthly area. What I want to show people is when we start getting into that November low of about 1350, we're up here at 1661. What it really means is that we have hit what we call a fifth wave target in the upside of the S&P. You can call it a fifth wave, an Elliot wave. That's what some of the retail people call it. We call it a fifth wave. I don't call it the wave. I call it that it's had five moves higher, which means that we've gone 300 points off of the lows in the S&P 500 to 1661, and everyone's been waiting for a correction. Now, one thing about these kinds of moves that happen from bear to bull cycles is it says that S&P momentum will change, and not only that, we're talking longer term. We start looking out to 2014, meaning that when these upper ends of these channels hit and they change, they start to come all the way back down. What does it suggest is it suggests various different things that can happen in this calendar year for 2013. Yes, we'll have pullbacks along the way, and you will bounce, and you'll be in trading range for the remainder of this year. However, when you get out a year from now, based on this fifth wave count and going out to 2000, I don't see where we have another big buying opportunity like we did in 2009 until 2016. That calendar year. That means that this S&P has a lot of room to go down after making these kinds of big moves and hitting 12.5-year highs. The bear was in this market for almost 13 years from calendar 2013. But what I am saying to people is that we will have some dips, and then we'll buy them, and then we'll sell at resistance. But longer term, the S&P will go down. And some of it will be tied to the economic policies, such as QE3s, and what the Fed does. But at some point, we have never seen before where these things last to the upside. Longer term, when we make this kind of fifth wave movement up here in the S&P, the forward-looking calendar years look that we would come down in 2014, 2015. And that we've had this great big rally, 300 points up, we're overbought, we're at 1661. The higher that we go, at some point when it does reverse for calendar 2013, it'll be in a trading range only. So when the S&P drops down here to, let's say, 1510, that would be a nice pullback, but still you would continue to go higher. The upper end of the S&P from 1661 in this particular count could go as high as 1710. It is possible based on how the algorithms have been working. The thing that I'm going to tell people is to be very careful over the forward-looking years in the S&P hitting a fifth wave count, and that they do reverse and come down. Now, it's a bull run for calendar 2013. This isn't all going to happen in calendar 2013, but forward-looking over the next couple of years, we would be coming down substantially in the S&P 500. Okay? Right now, it's a trading range. Buy the dips and sell at resistance. So when we do get a 5% correction that hasn't come in May, that everyone was waiting for, it really doesn't matter. We've hit the fifth wave to the upside, and you can overshoot that fifth wave, but then we start to reverse and turn down as we move through the remainder calendar year of 2013, going into 14 and 2015. That the S&P does just the opposite of the fifth wave up, but then it trades down. So I just want people to know, my long-term people, to understand that this S&P has hit a fifth wave in the Elliot wave, and it's up at the highs, and it can overshoot it. Right now, we're trading 1661 right here. So we'll be updating people as to what this fifth wave reversal, when it does come in calendar 2013, sometime this summer or toward the end, is that it would only be the beginning, but they would be tradable off of support, and then you'd go back up and you would go through it because it's a time series cycle. It's a calendar time series cycle. So these time series cycles that are forward looking out to 36 months in the S&P is that the S&P will trade much, much lower than what we know it today, even below 1350 over here. So we'll keep people updated in a quarterly aspect and a 6-month type of term. But then when that wave does reverse and start to go down, it's a time series element. It's a trading element because right now the bull is as strong as we've seen it in a long time. Reminds me of 1999. So I'm just giving an update. You can send for an email if you want to learn more about it. But we have hit a fifth wave up in the S&P 500. There will be pullbacks coming, but once again, they're not just totally going to collapse in this year unless something fundamentally or something extreme happened in the U.S. Right now, we got everything working, but just remember, when the stimulus has come off, this fifth wave always has a reversal. Always. It's a time series. And so we're long-term people, and we're very constructive on it because right now, if I want to go buy puts below the market that go out to calendar 2015, I can buy those very cheap, 600 handles below the market for a long-term position on a fifth wave. I can trade the bull rally to go up in a shorter term all the time, and a time series element. And this might be over some of the people's head, but we'll be giving some individual training for people that want to understand why is the S&P the way it is today, but why in 24 months is the S&P much lower than what we see it today.